The management which reported numbers. JK Tyre is what we're talking about. Second quarter saw their revenues grow, but on a muted basis. Margins expanded. Company is also planning to expand capacity by nearly 20%. Anuj Kathuria is President India at JK Tyre Industries, is joining us right now to take some questions. Mr. Kathuria, great to have you with us here on CNBC-TV18 as always. Let me start by asking you, what is the outlook as far as demand is concerned for the second half of this financial year? Is it looking good? Because, I mean, if you look at OEM sales, there is a certain pickup there over the last couple of months. Are you seeing that, in this in the third quarter so far, and the outlook for the rest of the year?
Yeah, so thank you for having me on the show. So as we saw that for the quarter two, we have reported a consolidated net revenue of 3,905 crores, which is an improvement of 4% on a YOY basis. And the demand going forward, the outlook for the industry looks robust, both in the OEM segment as well as in the replacement market. So we expect that the quarter three and quarter four, and actually the second half as a whole, we should be seeing robust demand coming in the domestic market.
All right, robust demand in the second half for the domestic market. What, Mr. Kathuria, would be then your outlook for the export business for the second half?
Yeah, so talking about the export demand, as we remember that last year, the first half was good in terms of the demand, but in the second half, starting quarter three, the demand had fallen sharply. And quarter four was a period of low demand. But in quarter one this year, we saw some recovery. And in quarter two, again, further recovery we saw. In fact, on a consolidated basis, for us, our exports were actually grew with a good double-digit growth we saw in the exports over quarter one. And going forward, if I compare it with the second half of last year, which was a weak 6 months period for exports, I expect that the demand should be better. We will have to discount for the seasonality as well as the year-end change. So if I were to kind of discount that, overall the 6 months period in the second half of the fiscal should be good for demand. However, we will have to watch it carefully. There are certain global headwinds considering the geopolitical situation. But other than that, I think so some of the economies where we have presence in the international markets, those should be doing fairly well.
Okay, Mr. Kathuria, what is the outlook on margins? I mean, is there any scope for upside given the fact that raw material prices have softened as well? And there is also, of course, some operating leverage perhaps available to you.
So, yeah, definitely we got the benefit of the operating leverage. We got the benefit of the subdued raw material prices. More importantly, we also had a growth into segments and geographies. In the domestic market, we were definitely looking for these opportunities. I would also like to share with you that on the product side, we have been able to get our premium products, whether it is in the PCR segment or even in the truck and bus radials. The premium products have taken a larger share in the overall pie. So that helps us to improve the margins and not to forget the efforts that are on a continuous basis being done to reduce our costs as well as improve the capacity utilization. So all these levers put together have definitely helped us to report a very strong EBITDA margin at 15.3% on a consolidated basis. Going forward, as you rightly said, that we will have to watch the raw material basket very carefully, especially the derivatives that come out from the crude. We would be working towards that. But in my understanding, if the demand were to play out well, if it continues to be robust, there would be definitely an upside overall into the further bettering the capacity utilization. But the main focus would be to how to sustain the current levels of margins. But definitely this needs to be watched very carefully, and accordingly, we will have to take course corrections.
All right. So you are focusing on sustaining margins at these levels, barring any uncertainty. These should, hold out. But I'll go back to the international business itself, and this time specifically for the Mexico business. What kind of realistic growth are you looking at here on the top line?
So as I shared that, the Q2, we had a good double-digit growth in the exports on a consolidated basis. And we expect that similar levels should prevail in the coming quarters as well.
All right, double-digit growth should prevail in the coming quarters as well. Thank you, Mr. Kathuria, for joining in. That was the management of JK Tyre. See better domestic business in the second half of this year. We'll hope to maintain margins at current levels, and exports should come back. Double digits is what would sustain in the second half of this year as well, though they are watchful of global headwinds. The stock has seen a big rally over the last 3 months, up almost 27%. And today, too, that rally sustains with a gain of 8%. Mildly off highs, but nothing really to worry about out there for JK Tyre. Take a short break, come back.